As central banks across the world consider steps to stimulate their economies, the Federal Reserve announced an extension to their bond purchasing program known as Operation Twist. The existing maturity extension program was due to expire this month, but will now be extended through to the end of the year. Joining me now to discuss the market's reaction is senior economist Michael Gregory from BMO Capital Markets. Michael, thank you very much for joining me. Now, the Fed's announcement of an expansion to its Operation Twist program seems to be met with a mixed reaction in the financial markets. Overall, though, it seems like there was a slight sense of disappointment in the markets with the Fed's move.
Yeah, that's correct, and I do think that there's two things going on here. One is the proverbial buy on rumor, sell on fact, but more significant is the fact that I think many people, many investors, were hoping, betting that the Fed would do something a little more aggressive, outright quantitative easing, which they shied away from this time.
But it seems the door has been left ajar for more QE. When could we possibly again see more quantitative easing?
Well, I think what the extension of Operation Twist does is it provides some time for the Fed where they can wait and see how the economy unfolds, how Europe unfolds, and how the path towards some kind of fiscal resolution in the U.S. unfolds. But if either of those three things go in an incorrect direction as far as the economy is concerned, particularly Europe, particularly sort of the momentum in the economy, then I think the Fed will act. So if the Fed were to actually start flexing its balance sheet again, I suspect it would probably be more in the September meeting rather than the one that ends August 1st.
The question is, though, why now? What are the main factors which has convinced the Federal Reserve to take action now? Is it the downside risk to the US economy, the concerns over Europe, an effort to perhaps store a bit more confidence in the market, or is it actually just a combination of all of these factors?
Well, I think it's a bunch of little things. I mean, the European situation remains the key downside risk for the U.S. economy. It hasn't changed at all from that perspective. But what has changed is the fact momentum in the economy has slowed considerably, particularly in labor markets. Now, there could be technical reasons why that's happening. It could be because of the payback for the warm weather, or maybe activity had been dampened by the fact that some capital spending got pulled into 2011 at the expense of 2012 because of tax incentives. But the key thing is, though, it's probably more than technical, and it does seem that the declines we've seen in the unemployment rate are stalling. And as a result, given that this is one of the Fed's mandates to have maximum employment, they feel that they've got to take out extra insurance and in the event that these technical things are more than just technical or fundamental, and perhaps provide a little bit of impetus to the economy through lower long-term interest rates.
There are a lot of things up in the air going into elections, including this potential fiscal drag. Also, last year, Michael, the US debt ceiling debate caused havoc in the financial markets and even contributed to Standard & Poor's stripping the US of its AAA rating. Is a debt ceiling debate brewing again, and if so, how are markets likely to react this time around?
A lot will depend on what is the backdrop. Back in August when we went to the debt ceiling and there was a last-minute deal and there was a downgrade by S&P, not so much because anybody believed that Uncle Sam wouldn't pay its bills, but simply there was a lack of commitment to dealing with the deficit over the medium term, which is the ultimate criteria a lot of credit rating agencies look at for sovereigns. But just as that downgrade happened, you had a further escalation of tensions in Europe and the flight to quality, or flight to liquidity rather, safe haven flows supported the Treasury market just as you would think it would sell off. So let's push forward towards the end of this year when we will presumably hit the debt ceiling again, at the same time that we have to deal with the fiscal cliff, the fiscal drag that potentially could pull the U.S. economy into a recession if it's not eased back. But if it's eased back too much, then the credit rating agencies may act again, and we could see literally another downgrade of the U.S. So there's going to be a lot of tension, I think, on the fiscal front, and it's going to create a lot of volatility, weakness in financial markets. Whether or not it turns out to be a net negative or a net positive will again depend on what is the backdrop, what is happening in Europe. I'm going to cross my fingers here and take a bet that Europe finally seems to be on the path to some resolution, in which case this could be a net negative for the Treasury market, for capital markets generally.
In general, and in regards to the FOMC's economic outlook, compared to earlier this year where activity and data was beginning to look up, it's quite a gloomy looking picture being painted for the US economy right now, no?
Oh, absolutely. I mean, they've downgraded their economic outlook, at least for the next couple of years, by about 0.5%, which is significant in real GDP terms, and actually raised their projections for the unemployment rate by a couple of tenths, which is also significant. So it looks like that the Fed is getting extremely gloomy about the economy, which is one of the reasons why they decided to do what they did. It's quite possible that things might improve, and I think I think the Fed is going to sit back and wait and see what happens, and they've indicated that they're prepared to do whatever it takes. And importantly, I think in the statement we got from the FOMC, they inserted that it's not only about the economy and inflation, it's also about labor markets. When we come down to it, it's all about jobs. The Fed thinks it's won its battle over inflation, and their inflation target will be met. That's not going to be a problem. Their other issue is that they want to get unemployment down to 6% or lower, and it looks like they're going to have a hard time just getting below 8%. That's a big challenge for the Fed.
Michael, some very interesting points and comment made there. Thank you very much for speaking to me. We're drawing closer to the end of another trading week, but do stay tuned to Dukascopy TV, as coming up tomorrow we'll have more exclusive interviews and of course a closer look at the week ahead. Goodbye for now.